Well, the spring selling season heating up right now for housing. Mortgage rates, though, are getting cheaper. The average rate on a 30-year fixed-rate mortgage declining below 4% for the first time since November, according to Freddie Mac. Joining us right now is the co-founder and managing director of Digital Risk, Jeff Taylor. Jeff, good to see you. Thanks for joining us.
Good morning.
So you're a Mortgage Bankers Association board member. What do you think about this, that rates are moving lower, even though we are expecting the season to pick up in terms of business?
Well, I'll tell you what, it's a great opportunity if you're looking to actually buy a house to do it right now. Because if you would have told me rates were going to be higher even a month ago, I would have said there's no shot, especially what the Fed's been doing and signaling to do for the rest of the year. So I think it's a great opportunity for people to be in the housing market right now and actually making that first-time purchase or the move-up purchase.
Do you think rates keep going lower? Why are rates where they are, would you say?
I think the 10 years has a little bit of international volatility in it right now, and I think that's why it's dipped back down. But I don't think it goes lower. I actually think it definitely rises up here, in the next couple of weeks and months to come. So if you're thinking on the sidelines, if you're thinking about buying a house, do not think rates are going to get lower. They will actually rise through the next few months and the end of the year.
Wow, John.
Are you seeing activity now in the refinance end of the market or in the purchaser end of the market?
You know, it's a great question. So Digital Risk, we just recently did a survey on home equity loans, and it shows a couple of really interesting statistics. One, that the home equity loans are at the highest point since 2007. But most importantly to that, people are actually using them responsibly, 58%, to improve their houses. A couple other points that we saw. 1 in 5 people don't understand what a home equity loan is, and 30% don't know how to get them. And if you look at the Harvard study that just came out last week, which shows that remodeling is at an all-time high at $350 billion last year, that means people are really looking to improve that existing house they have right now. And a home equity loan is a great way to be able to do that at like 4% versus a credit card at 17%.
I wanted to ask, does this mean that people are less afraid of debt now, or they're just more likely to use it for more serious purposes? But, I mean, how afraid are people now of adding debt to their existing mortgages?
That's a great question. So, on the survey, 32% said that they were fearful of adding debt because of an adjustable rising rate interest rate environment. But I think it's like everything else. Debt, if used responsibly, is a very good thing. But when you're using, for instance, debt, what's happened during the crisis, taking equity out of your house and using it for lifestyle expenses, that's a recipe for disaster. But used for meaningful things like a home improvement or maybe a lifestyle event, a life event like a medical bill, is a very responsible tool.
But Jeff, you talk about meaningful things like home improvement. During the housing boom, we saw people pouring money into McMansions, adding all kinds of bells and whistles on their homes that in the end they couldn't afford. Isn't there a risk that we get back into that kind of environment with people blowing up their houses into these McMansions that are ultimately not going to pay off for themselves?
Yeah, so I'll give you a two-part answer there. Back during the crisis, right, a lot of the home equity loans were being securitized. So let's say the due diligence that was being done on them wasn't nearly as deep as it is today, where the banks are actually putting those on balance sheets. So they're very much monitoring what they lend against, where it goes. The second thing right now is, look, across America right now, sales are at all-time highs in houses, price appreciation, so people can't really sell their house to move. So to increase the lifestyle or improve where they want to live, they're pouring money responsibly into their house is sort of how we're looking at it right now.
But, Jeff, isn't the danger that you take out a home equity line of credit, and you spend it on all these improvements, and people have been conned into believing that they get, for every $1 improvement, they get a $2 increase or even a $1.50 increase in the value of their home. And in many instances, that's just not the case.
That's a very, very good point. So again, taking out the money to improve the house has got to be consistent with what you can afford. It's all about affordability. So if you're doing it because you think you're going to improve the house and you're going to flip the house and make a profit, that's the wrong reason to take it out. You should be taking it out because you want to make improvements to the house. You're either there for the long run or in your overall financial picture, you can afford the payment. And that really is the key to life, or taking out any debt instrument.
Do you think a new kitchen or remodeling parts of the house adds to the value of the house?
Yeah, absolutely.
You do?
And I think that's why you're seeing. I
Yeah,
do.
because
And
I
I think
think
that's why you're seeing
we're
stock.
having this debate over and over. I mean, whether or not putting all that money into your house to redo the kitchen or put a pool in the backyard, does that really matter?
It depends where you are in your life. I mean, if you can afford, if you can take out that home equity loan and you can remodel the kitchen, that means a lot to you. And a pool definitely could increase the value of the house. But also, what's your overall financial picture right now? Can you afford it? And then I look at stocks like Lowe's and Home Depot.
I don't think Dagan believes that. That's what I'm saying. We've had this discussion before, right? You don't think it matters.
Pools actually can decrease the value of your home.
People might not want the pool.
Right, particularly if you end up trying to sell the home to parents. And it just depends on how much money that you spend on it. If you cannot sell your house, period, because the kitchen is from 1965, I'm just kidding.
The other thing is
then that's a problem.
You remodel the kitchen and then someone else comes in.
They want
their own kitchen, so they rip out the kitchen that you spent thousands of dollars on.
Final word, Joe.
Because remember, we're also talking about.
Right.
We're also, that's kind of right? I mean, but you're talking about, if you're doing a home equity loan because you're looking to improve the house because you're looking to flip it or to sell it, that's one statement. If you're looking at it because, hey, I want to be here for the next 10 to 15 years and it means a lot to me and I can afford it, that's the proper use. So that's
and then
where
you'll need another new kitchen.
And then 10 years later, you'll need something else to get the value up. Jeff?
If anybody wants a kitchen that looks like the one in Bewitched, with black and white, with the pull-up stove, I've got a house for you. My house isn't on the market.
Jeff, thank you.
That's great.
Jeff Taylor
Thank
joining
you so
us
much
there.